Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a consolidation. A consolidation where we have a parent-subsidiary relationship, the parent owning over 51% of the subsidiary, having a controlling interest, but not 100%. Therefore, we will have a non-controlling interest to deal with within the consolidation. Our major focus here will be with preferred stock. So we're going to have the parent company owning some of the preferred stock as well, and so we'll be dealing with that within our consolidation. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We are in section 932. So if you have access to OneNote, and note you don't need to have access to OneNote, but if you do have access and you want to follow along with it, then we're on this 932 as the section. We're going to go over the content that will be included, and then we'll pull pieces of that content as we work through the problem. So we have P owns a percentage of S. P is going to be the parent. S is the subsidiary. The common stock is going to be 90%. The new thing we're concentrating on here is the preferred stock. P owning 60% of S preferred stock. Now, first thing we want to note that when we think about this, what's the difference between the two? Just to kind of review here, the common stock is the stock that's going to basically make them a controlling interest. Why? Because that has the voting rights to it. So if they're over 51% of the common stock, you would think then they have control because then their vote basically goes. And so the common stock is really what we're looking for with regards to the controlling interest due to that. The preferred stock, why is the preferred stock preferred then? Because typically they're often going to get paid, the way the preferred stock is going to work, oftentimes they're going to get the distributions in the forms of dividends go to the preferred stockholders given the terms of the preferred stock before the common stockholders. So that's going to be the benefit of the preferred stock. So when you think about this, obviously with regards to the consolidation, you're going to think, all right, the common stock, if that's over the 51%, you would think that's going to be the driving factor as to whether we would be consolidating or not. The preferred stock then is going to muddy the waters for that consolidation because we're going to have to think about how the net income of S would be allocated given the fact that we have the preferred stock, and the preferred stock may, again, first go to the preferred stockholders and then to the common stock. Okay. So then we have the purchase of book value on January 1st, 2000 x 0. So it's purchased at the book value. We don't have the differential. So no differential to worry about here. Fair value of the non-controlling interest is the 10%. So it's 90-10 broken out for the common stock, preferred stock. As preferred shares, annual cumulative dividend. So there's an annual cumulative dividend on the preferred shares of 7.5%. December 31st, current year dividends declared and are paid on January 1st of the next year. So now we're going to put some tables together, and those tables are going to help us out with that first journal entry that we will make within the consolidation problem. So to the right, we have our trial balances. We've got the P trial balance and the S trial balance, parent and subsidiary. We're lining them up side by side. We're going to be adding them up within the consolidation process. Down here, we've got the investment in S preferred stock. That's going to be one of the new things that we're going to have in place, and we're going to have to eliminate that account for the consolidation or within the consolidation journal entry process. And then we have the investment in common stock, which of course we're going to have to eliminate that as well. If we go down to the equity section, we got some new kind of things here, which is going to be the preferred stock. So we're going to have to deal with the preferred stock in the equity section. Then we have the dividends on the preferred stock that we're going to have to be dealing with as well. Then down below on the income statement, we have the dividends income reported by P for the preferred stock distributed by S that we'll have to deal with because that's an intercompany income account. And then we have the income from S, which is our typical kind of account on P, accounting for equity in S using the equity method. So first thing we want to do is basically reconstruct the equity section for S. And that's our first journal entry typically deals with the equity section. So let's think about the equity section first. Then we'll reconstruct it with regards to the non-controlling interest and how P is recording for their interaction with S or their investment in S. So within S, we can think about the full equity section as basically either assets minus liabilities, the green accounts minus the orange accounts, or basically all of the blue accounts being the equity accounts. So let's kind of recalculate that. We're going to say, all right, the book value, the beginning book value of the preferred stock, if we add this up, we're going to say here's the $175,000, Here's the common stock beginning amounts, $95,000, and the retained earnings beginning amounts of that $245,000, adding up, summing to the $515,000. Why are these the beginning balances and not the ending balances? Because this trial balance is as of the end of the year, because there's no activity typically that's going to be happening to the preferred stock and the common stock unless more stock was issued or something like that during the time period. So those will be the same as the beginning. There won't be any activity for those. And then the retained earnings is going to be the beginning balance because we have not yet closed out either the dividends or the retained earnings to them. You can see the dividends being broken out here into a separate account. So they're not included in the retained earnings. Therefore, the balance that's in the retained earnings, no activity in the GL forward, is therefore the beginning balance. Net income will then roll into it, as will the dividends, during this period or in the statement of equity. So then we got the net income that's reflected down here at the bottom. So we got the 111,000. That's going to be the net income. That's going to be going into the retained earnings to get us to that ending balance. Then we've got the preferred dividends. So the preferred dividends are going to be here. They're going to be a negative within our calculation. So they're going to be rolling into retained earnings as well, bringing retained earnings down. Then we've got the common dividends. This is the activity that is happening. Normal dividends. That's going to be reducing the retained earnings. And that will give us then our ending numbers being preferred stock, no activity from beginning to end, 175,000, common stock, no activity, 95,000, the retained earnings, 333, 375, and total, the 603, 375. So to help us out with that first journal entry then, we're going to do that same calculation basically up top, but think of it in terms of P and how they are accounting for their investment in S. Now, other ways just to think about this, we could just simply calculate. We're looking at basically the total equity section, which you can calculate as assets minus liabilities or total equity. So if you had a trial balance laid out like this, you could just basically highlight this and say 90,000 plus 140,000 plus 218,000 plus 285,000 minus the 1165 minus the 13125. And that's going to give us our 603, 375. Same thing, assets minus liabilities, or we could take all of the equity section, which is what we just basically did with this table. But sometimes it's easier to just see in a trial balance where we would just say 175,000 plus 95,000 plus 245,000 minus 13125 minus the 9500. And then I'm just going to add the net income, which is all of these, the bottom portion. So we're going to say plus the 111000. And that's the 603, 375. Now let's consider the beginning book value of the non-controlling interest. So beginning book value of the non-controlling interest, we're basically looking at this item here. So if we then go into this, I'm going to say, okay, so the common stock is 340,000. So common stock, and where I'm pulling that is I'm pulling that as of, let's pull up the trusty calculator. We're including the retained earnings in this calculation. So we're taking the 95000 plus the 245, and that's going to be the 340,000. And then we're going to take the percents, the non-controlling percent being 10. It's broken out 90-10. So 90-10 is the breakout. There's the 10% there. Then we have the preferred stock at the 175,000. The 175,000 times the 40%, because recall that the breakout on the preferred stock, the parent owns 60, so it's a 60-40 breakout for the ownership of the preferred stock. So that's going to be the 70,000, and then if we add this up, we're at the beginning book value of the non-controlling interest, which we're going to say is this 104,000. So now let's think about how we would break out the net income. So the net income is this 111,000. That's just going to be revenue minus expenses for company S. But now we got this preferred stock that we're going to have to deal with. So let's do some calculations here, which will help us to basically do that first journal entry for our consolidation. So we're going to say net income is the 1110. And then we have the preferred stock, which is going to be the 13,125. The 13,125, and we could see that here, the preferred stock, 13,125. If we remove that then, and you can also calculate it, by the way, up top with the data is 7.5%. So if we was to say, okay, preferred stock is going to be the 175,000 times 0.075, is going to be that 13,125, which are what's given here as the preferred dividends, the 13,125. That's total. That's including all the dividends for preferred stock, both controlling and non-controlling. If we then subtract that out from the net income, here's the net income after the preferred dividends, and that's going to be the 97,875. Notice that preferred should have an E there, I think. I don't know why, but in any case, hope that doesn't bother anyone too badly. It's kind of annoying to me here. But anyway, if we subtract this out, we're at the 97,875. Then we can break that out between the controlling and the non-controlling interest. So now we got the net income after the preferred dividends. So now we got the 97,875, and we could take that times the controlling interest 0.9. There's the 88.87 about rounded. And then we're going to take the 97,875 times the 0.1, and there's the 9788, the 9788. So then if we consider, now that we have this 9788, we're going to think about, okay, what if we were to add back their portion, the non-controlling interest portion of the preferred dividends? In other words, the 13,125, if I take that 13,125 preferred dividends, and we pull out the non-controlling interest portion of it, and the preferred dividends were broken out 60-40. 60-40 breakout. So the non-controlling interest would be the 40. So I'm going to say times 0.4, and that's going to give us the 5250. So then if we take that and we add it to the 9788, we're going to get the 1583. So there's going to be our 1583. Basically the net income, including the non-controlling interest portion of the preferred dividends. So we're going to be using these numbers in our table up top now, and this is going to be the table that will be principally useful for us in our first journal entry. So we're going to get to the same number, the 603,375, which is the same as assets minus the liabilities, or the equity section. So we're basically calculating the equity section in the normal way here. Now we're going to be breaking it out with the non-controlling interest, the investment in preferred stock, and the preferred stock dividend income, investment in common stock, and then the total. So the beginning values, we're going to have the non-controlling interest. The 104 is going to be the beginning value that we calculated down here. So that's the 104. Then we have the investment in preferred stock. That's going to be the 105, which we're pulling directly from the P's trial balance. There shouldn't be any change to it. Then we're going to have the preferred stock dividend income, which we'll see shortly. Then we're going to have the investment in the common stock. If we pull out our trusty calculator here, we can look at the common stock. I'm looking at common stock and retained earnings here. So we're putting in this column, which is going to be the 95,000 plus the 245,000. So that would be the total. I'm going to take the controlling interest portion of it, which is 0.9, 90% of it. There we have the 306. So then the 104, the 105, and the 306 is going to give us that 515 total. And that equals our beginning balance down here. Our beginning balance here, the 175, the 95, and the 245, which is here, here, and here. Okay, and then we're going to have the net income. So the net income for the non-controlling interest, this is where we're going to be pulling in that 15,038. The 15,038 is this number we came to down here. So we calculated this number and this number. And recall that we pulled out the preferred dividends because we're going to be showing that in the next line. So we got the net income allocated to the non-controlling interest, and then we're going to be dealing with those preferred dividends. And then on the preferred stock dividend income, we have the dividend income down here that's calculated at the 7,875, the 7,875. Or we can think of it as this 13,125 times that's the preferred dividend here, times the portion going to P, the controlling interest, 0.9. And that's going to be then, that's not right because that's the common stock percent. It's the 13,125 times the P's portion of the preferred stock, which was broken out 60-40. So that's going to be times 6. And that's going to be the 7,875. So then we have the investment in the common stock. Investment in the common stock, we could see down here is the 88. We also calculated that down below. That's where we calculated the net income minus the preferred stock to get the net income after the preferred stock. Then we broke it out and we see that 88,088 here. So scrolling back up, if we add these up, then that's how we're going to be breaking out the net income. So that's going to be, in other words, adding this column up adds up to the 111000, which of course is the net income for S. That's going to be our breakout for the net income of S. Next line is the preferred dividends. So the preferred dividends, you can see, are the $13,125. The amount that's going to go to the non-controlling interest is going to be that $5,250, which we calculated down here. So there's the $5,250 that we calculated down here. You could take the total dividends, the 13,125, times the non-controlling interest is broken out 60/40 for the preferred stock, so times 0.4. There's the 5250, and then the preferred stock dividend income here is going to be for the controlling interest, which is the 7875, or of course the 13,125. Whoops, yeah, is that right? Yeah, times the controlling interest 0.6. Okay, and then that's going to give us our total. Our total then lining up to what's on the trial balance. Okay, next item is going to be the common dividends. So the common dividends are here. They were distributed 9,500, and that's going to be in comparison to or using the controlling interest 90/10 breakout. So the 9,500 times the 0.1 is going to be that 950, and then of course, 9,500 times the 0.9 is going to be the 8855, or the 8550. And then that's going to give us our totals down here. So let's just delete this altogether. That'll give us our totals, and then our totals adding up to that 605,375, that matching then what we have down here. So we've calculated the equity section, recalculated it given the non-controlling interest in our breakout here. So now we're going to use that in order to construct our main journal entry now. So here we are with our main journal entry. We have the investment in S and preferred stock and common stock. That's going to be these two accounts. Those are going to have to go down to zero. We're going to go back to these numbers in a second. So let's continue to the next one, and then we'll go back up to the numbers there. And then let's think about the equity section that we need to remove now. There's a couple more items within the equity section, but the process of us removing them is in essence the same. We're going to basically remove S's equity section, which now includes the preferred stock. So the preferred stock's on the books at that 175,000. It's a credit. We're going to debit it to make it go down. We have the preferred stock parent subsidiary. Adding them up, we will remove the subsidiary back to the parent's stock. So this is us posting that transaction. Next transaction, we got the common stock. So once again, we're going to remove that 95,000 for S. That's going to be a debit here. So we have parents, we have the subsidiary, the total. We will remove the subsidiary, getting us back basically to the parent. Then we're going to go to the retained earnings. Here's going to be the retained earnings. It's on the books for the subsidiary at the 245,000. So we will debit it by that 245,000. Parent, subsidiary, total, removing the subsidiary back to the parent. Then we're going to go to the dividends for the preferred stock. Again, another new item, but same treatment as far as this component of the journal entry as other dividends, meaning we're going to remove them. So that's going to be on the books as a debit. Therefore, we will do the opposite thing to it, a credit. So there's the credit. Once posted, there's us posting it, and here's it going back down to zero. Then we have the dividends for the common stock. Once again, it's on the books. This is normal process as a debit. We're going to remove it with a credit, so we will credit that. So here's these two accounts adding up. Then we remove that S's portion, bringing us to the 58,500. Okay, then we have the income from S. Income from S is going to be this item. Now, normally we've been calculating that. We're taking the full amount off here, so you could say, okay, we just take the full amount off. But normally we calculate that as the 111,000, the net income down below here, times the controlling interest, or the 0.9. That would be the 99,900, but we're going to the 8888 because of this calculation down below, where we had this calculation here. That was, we added the investment and the book value here, and you can also see that calculation up top where we took the net income minus the preferred stock, which is spelled wrong. Sorry about that. But in any case, then we got the 97,875. Then we broke it out. So this is basically the net income after reducing the net income for the preferred stock. So there we have that. That being posted out takes us down to about 0. It's rounding. There's a rounding error of 1, so hopefully that's okay. It doesn't bother anybody too badly. And then we have the dividend income on the preferred stock. So here's the dividend income on the preferred stock. We have that $7,875. That, of course, needs to be removed because all that income came from S. So we got to remove that. You can also see that in our little table down here that we worked, either this item or that item. You can take into consideration for that $7,875. And once we remove that, if we post that here, goes to 0. Then we're going to go to the non-controlling interest, the $15,038, which is calculated here, the non-controlling interest. Now, normally we would think that calculated as 111,000 times 0.1, the non-controlling interest, and that would be 11,100. But once again, it's going to be this item from our table. That item was drawn from this table up top, that 15,038, where we basically took the portion, we took the net income minus the preferred stock. Here's the portion allocated to S, and then we put back in the preferred stock that would be allocated to the S, or I should say non-controlling interest might be a better term there. And then that's going to be our 15,038. Then we have the non-controlling interest in NA, which that would normally be calculated as our net assets or as our equity section. So for example, we might normally say that the equity section would be 175,000 plus the 95,000 plus the 245,000 minus 13125 minus the 9,500, and then adding the net income, which would be the rest of it, 111,000. Normally the 603,375 times the non-controlling interest, which would be times 0.1. That would be our normal kind of process, but instead of that, we're going to take this from our table, the table we did down here, and that's going to be the 111,838. So we had the beginning balance, then the net income, the preferred dividends, and the common stock for the non-controlling interest, making up that 112,838. Now let's go back. We'll take a look at the investment in the common stock and the investment in the preferred stock. Now the investment in the preferred stock is going to be this number here, the investment that we have. There's been no change from the beginning to the end. In other words, if we took it from the table here, we've got the same activity, so that's going to be the 105,000. Then in the common stock, typically that would be normally what we've been doing is the net assets, similar calculation as we did down here, times the controlling interest, which would be the 90%. But here we're going to be taking this from the table. So the table is going to be this item on the table, and that's going to be the 385,538 calculated here as we did prior to this. And there we go with that item. Now, if we were to post this out, of course, then posting this out, going to bring this down to 0 or 1, close enough, hopefully for everybody here. And then we got the 105 being posted out. That's going to bring the investment in the preferred stock down to 0. We took a look at all of the equity accounts already. And then we went to the income from S. So income from S going down to 1 or 0, rounding. And then the dividends for the preferred stock, bringing it to 0. The non-controlling interest down below is going to be posted here. And then the non-controlling interest in the net assets is going to be posted up top here. So at the end of the day, of course, these items are going to be at 0. We've got the equity section basically reflecting P's portion. So we had P and then S. We removed S. We're back to basically P. That's going to be the standard process. The dividends from the preferred stock have been removed because they were intercompany, and the income from S is down to 0.